Hello and welcome. This is Bobby Carlton. I'm the founder of Innovation Women. Innovation Women is a visibility bureau for entrepreneurial, technical, and professional women. We connect women with speaking opportunities, and we connect event managers with awesome speakers who just happen to be women. Our mission is to eliminate the all-male, all-pale, and all-stale panels you see so often at industry conferences and events. We help both speakers and event managers. And Innovation Women is so much more than a traditional speakers bureau. Event managers can search the database for free, and speakers pay just $100 a year to become a member. Some features of our site include calls for speakers that event managers post. Our speakers and our event managers can also search our platform. The event managers can search for speakers, and the speakers can search for speaking opportunities. We also manage and allow the speakers and event managers to manage the applications and invitations on their dashboard. We have robust keyword search functionality, and our speakers have public profiles and shareable links. We offer a 20% discount on Innovation Women for all the people who are joining us on today's webinar. If you'd like more information on Innovation Women, check out our website, innovationwomen.com. And this year, our webinars are themed every month, and we post the call for speakers on our own platform. If you're interested in hosting one of your own webinars, apply on the site with your proposed webinar talk. The deadline to apply to the May 13th webinar on mental health awareness is April 13th. So, before we get started today, I'd like to encourage you to register for our next webinar. On April 15th, Lana Carter will join us to discuss financial literacy in Be Informed, Balance Sheet and Income Statement Basics. You'll learn how to read and understand the interplay of a balance sheet and income statement, how these accounting reports inform on the financial health of a business, how to identify smart questions that may reveal additional financial information that will help you prepare for seeking additional investments or deciding how to invest in another company. We hope you'll join us. You can register for this webinar in the Attachments tab. And we have a bonus webinar this week. In addition to our regular webinar series, I'll be having a conversation with one of our Innovation Women speakers, Joan Michelson, this Friday. We'll be discussing the opportunities in staying home during this time period. Though many of us feel trapped and a bit at wit's end, we can use this time to move our goals forward. If you're not sure what projects to tackle or how to find opportunities in this tough time, or just want to brainstorm with us, join us for this webinar. And this is an annotated version of your screen. Below the video viewing window, there are tabs. The default tab is Ask a Question. You can type in a question or a comment at any time during the program. The Attachments tab is where you'll see documents and links from today's speaker and the link to sign up for our next webinar. You can download the attachments at any time during this webinar and from the recording. The tab called Rate This helps us determine what you like. We read all the feedback, so feel free to tell us anything. And you can enlarge your screen at any time to view in full screen mode. If at any time you need audio help, feel free to click on the Help button at the bottom of the screen to get access to the BrightTalk Help team. And today's webinar is being recorded, so if you'd like to review it again, you'll be able to through the link we send you in an email after the webinar. And so now on to today's presentation. With us today is Renee Caputi, and Renee is the founder and CEO at Enhanced Solutions Advisors. Renee is a trusted advisor who provides consultative and advisory wealth planning to cross-border and U.S. entrepreneurs and families. For those listening, please note you can ask a question at any time, and this webinar is being recorded for future playback at your convenience. Renee believes that by making information more accessible, decision processes more transparent, and data more trackable, she can help you enhance your alpha. We are very excited to have you join us today, Renee, and I'll turn things over to you now.
Thank you very much, and welcome everybody. I'm excited to be here today and talk about what I call Wealth Alpha. And I want to start with a poll for you guys and see how comfortable you guys are with your personal finance and your path toward financial wellness.
All right, and that poll is pushing live.
Thank you. So while we're waiting for the poll to push live, what is Wealth Alpha? So what I consider Wealth Alpha is the difference that you can make in your own lives and the lives of others by capitalizing on the unique blend of resources, connections, and know-how that you specifically possess. It's the synergy that you can create at the intersection of your business or career and your life when you have a plan that's built around what actually matters to you. So you can take control of your legacy by creating your own definition of success and crafting a plan around what actually motivates and inspires you. It's not financial planning. A financial plan is definitely part of your journey that the Wealth Alpha Roadmap takes you on, but it is not in and of itself only financial planning. So what we're looking at is, have you maximized the resources you actually have available to you today, and what is your definition of success? So I see that all of you are either somewhat uncomfortable or very uncomfortable with managing your personal finances. So I'm glad you are here today. We're going to take a little bit of the mystery out of it, and I'm going to try to help teach you how to look at money as a tool to reach your goals, not a goal itself. So there's 8 key factors in looking at your Wealth Alpha, which is your stable foundation for your finances. And they are investment planning, which is diversification of assets, as well as looking at what timing of your goals is and what risk tolerance you can handle. Risk management is all of those different insurances, property casualty insurance, auto, home, property, life insurance, disability, long-term care, as well as proper titling on your assets. And we're going to talk about that. Managing your liabilities properly. We're going to talk a little bit about ratios you can use to actually keep track of how you're doing. And cash flow management, so when, where, and why of your personal economy. And that ties into next week's presentation, so I'm going to talk a little bit about how to use balance sheets and income statements personally in your life. So if you then want more information on them, it sounds like next week would be a great webinar, or on the 15th to attend. We also have retirement planning or business succession if you're a business owner. They are one and the same. What does the next stage of your life look like, and how do you fund it? And then we're going to look at your distribution plan at death. So probate avoidance, privacy of what you're leaving and whom you're leaving it to. And then we're going to talk about the fact that estate planning is not just about taxes. Then we're going to talk a little bit about tax planning. I'm not going to get too in-depth. All of this is a very 10,000-foot view to give you an idea where to start. And then we're going to talk about setting the goals. So why are you doing all this work? So number 1, investment planning. Matching your investment plan to your time horizon is a key driver in creating that Wealth Alpha. So you need to be looking at, am I taking more risk than I should be? An example of that would be, if I'm getting ready to retire next year, I don't want to be in the market right now completely with all of my money because I'm going to need to be using it next year and we don't know where things are going to be. So you need to be looking at the timing of your goals along with the timing of those assets that you'll be using to fund them and make the risk level match the time frame. You also need to be looking at, am I making less than I should be? So looking at how much risk you're taking with the investments that you have and how much you're actually earning from them. Because when you take a specific level of risk, when you look overall in the market, there should be a certain amount of return you're getting for taking that risk, and that's what needs to be looked at. So when I talk about diversification of assets, I don't just mean asset classes. Everybody has heard that from every financial advisor or money manager. You need stocks, bonds, mutual funds, and all different things within your portfolio in order to diversify the risk of losing money in any one. But there's also diversification of locations of those. So I have a client who has commercial property, and when I first became involved with him, I looked at where his commercial property was. Every single piece of property he had was in the same hurricane zone. One hurricane would have wiped him out. So we talked a little bit about diversifying his assets. So location, but also diversifying income. So I know, especially now with everybody being stuck at home, there's all kinds of advertisements for start your passive income flow. There's something to that. Earned income you work for, so you're trading your time for money. Passive income you use to set up so that you're not trading your time for money. You set up an income flow. And we'll talk a little bit further on that a little bit later. But then there's also diversification of your tax treatment of the income that you're earning. There's taxable income, which means you earn the money now, you get taxed on it now. Tax deferred income, meaning it will continue to accumulate until some point in the future when you start to take it out, and then you're going to pay taxes on it. And then there's tax-free income, which means you're never going to pay taxes on that income earned. And a proper mix of those lets you respond to changes in tax law by adjusting how you're earning your income to keep your tax bill down. Risk tolerance and goal timing is very vital. So you not only have to match your plan with how much volatility you're comfortable with, because if you don't and you're not comfortable with the volatility, you will jump in and sell everything at the wrong time and blow up your plan. So the key is being at a level that you are actually comfortable with and you can sleep at night over. And then there's another piece to investment planning is the types of accounts that you can invest in. So one of them would be qualified retirement plans. What are those? So there's two different basic kinds of qualified retirement plans. So what are those? Defined benefit plans and defined contribution plans. And the reason they matter is because the burden of the performance of the investment lies with different people depending on the type of plan. So if you have a defined benefit plan, that's exactly what it sounds like. The company or whoever's offering you that plan defines the benefit you're going to get at retirement. They tell you now, so you're going to get 50% of your last 5 years average pay every year in retirement. They're telling you how much you're going to get. What that means is they put money away every year into a plan, and an actuary tells them how much they have to put away to keep that promise to you. If the market goes down and they lose money in their investments, the following year, the actuary is going to tell them they have to make a bigger deposit in order to still keep their promise to you. So they bear the risk. Whereas in a defined contribution plan, which is what more people are familiar with now, it's exactly that. It defines the contribution the employer is going to make toward your retirement, but they're not guaranteeing you any kind of income at the end. So that would be your typical 401k plan where an employer might match, we're going to match up to 6% of your salary for every dollar you put in. And then it says this is how much we're putting in, but it does not guarantee a payment out the other end. So if you make bad choices in your 401k investments, then you're going to have less money to live on when you retire. That's why the difference between the two are so important. Then there's individual retirement accounts that you can set up. There's different kinds: Roth IRAs, regular IRAs, or what's called a SEP IRA if you're self-employed. They matter because there's different tax treatments of deposits and different tax treatments of retirement income on those different types of accounts. With a Roth IRA, you don't get a tax break right now for putting the money in, but when it comes out the other end in retirement, you're also not going to get taxed on it then. So if you're in a lower tax bracket now than you expect to be in the future, it makes sense maybe to use that type of an investment vehicle. A regular IRA, on the other hand, is going to give you a tax break this year for putting the money in, and when you take it out the other end, you're going to pay tax on the money when it comes out the other end. So if you're in a really high tax bracket now and a lower one assumably later in retirement, then that might make more sense because you're going to get a break on your higher income taxes now and then pay at a lower rate later when you take it back out. A SEP IRA works like a regular, but it has higher limits based on the self-employment income. Stock options are usually offered by employers. Why is it important to know what they are? If you have them, then the options need to be exercised in certain situations, and the dates are very important for the awards. You also need to understand some stock options are taxed when they're awarded, and some are taxed if you actually exercise them or sell the stock. So you have to know the dates and the requirements. I had a client once who didn't really understand all of the trigger dates in his stock options, and he was ready to exercise some when if he waited literally another 2 weeks, he made like $300,000 more off of those options by waiting, just by understanding the dates. So very important. And then you have what's called non-qualified accounts. Those would be the money you're saving after taxes into brokerage accounts, or you open a mutual fund with Fidelity, or you buy an annuity. Those are typically taxable as you earn money on them, unless it's in an annuity, and then the taxation would be deferred until you withdraw it. Key number 2 is risk management. Am I properly covered? So in this case, I'm going to talk about titling, different kinds of insurances that can cover you, but risk mitigation is very, very important. You can work your butt off and save all kinds of money in accounts. If they're not properly titled and you don't have the right insurance, one car accident could ruin it. So it's very important for you to always be looking at your insurance coverages. So the first thing is asset titling. Who actually owns those investment or those accounts? So you have single names, so Renee Caputi, or you have tenants in common, Renee Caputi and John Smith, tenants in common, which means we each own our portion of that asset and can leave it to whoever we want. So I can own a building with John Smith, tenants in common, and if I pass away and leave it to my brother now owns the building with John Smith. Joint with right of survivorship means John Smith and I own the building, and I passed away, John now owns 100% of the building because he owned it jointly with me, and then he had the right of survivorship when I passed away. Joint tenant in entirety is for married couples only, and it does afford an extra level of asset protection in that if you own something joint tenant by entirety with your spouse, then only a liability that's attached to both of you can go after that account. However, one of the biggest ways to blow that up is I see a ton of spouses title their vehicles jointly. So if I'm driving the car that I title jointly with my husband and I get in a car accident and I get sued, my husband's getting sued too because his name was on it, and now any accounts that we had joint tenants by entirety can be attachable if we lose that lawsuit. So something to be careful of. A lot of people use that for asset protection without making sure all of their ducks are in a row. Then we have diversification, which I've already talked about, not just investment assets, but sources of income, tax treatment of your cash flows, real estate locations, etc. Also in risk management, your liability insurance, so auto insurance, homeowners insurance, any property policies, motorcycles, boats, RVs, and an umbrella over top of it to make sure you have higher policy limits in a very cost-effective way. And then you have property insurance, which is the underlying, now the liability is for an injury that occurs to somebody else. Your property insurance is for damage that actually occurs to your property. Then you have long-term care insurance. Who's going to pick up the tab for your care if you need 24-hour care or even significant care for activities of daily living, and how does that fit into your overall budget? And then we have life insurance as a piece of protecting risk management. It can be used to replace income if you pass away while you're still working. It can be used for liquidity to pay estate taxes if you have them. It can be used for pension maximization. So in cases where somebody has a defined benefit plan, they may have different options of your pension payment is $2,000 a month if you take it only on your life and not you and your wife. But if you take it on you and your wife, you're only going to get $1,500 a month. Sometimes you can take that extra $500 and buy life insurance to get the spouse enough coverage that they can replace the income so that they can take the higher amount of the pension. And when it's gone, the life insurance will replace the income for the spouse. Then we have looking at life insurance that's already in place. Do you have the best policies for your current needs? So life expectancy tables have changed dramatically over the last several years. And so people who bought policies back in the past, even though they're older now, sometimes can actually buy policies as an older individual and pay less premium for the same coverage because of the change in the actuarial tables. Then you have disability insurance. You're actually more likely as a working adult to be disabled than you are to die, yet most people ignore this coverage, which is vitally important. Some states offer short-term disability coverage for a number of weeks or mandate it. And then you have long-term, though. What do you do if you are now not able to go to work and can't earn an income? How does that fit into your plan, and how do you take care of that? I saw somebody say that the slides are too small. You can make them full screen as well to get them a little bit bigger. So liabilities management is a very, very important piece to financial wellness. Using debt wisely is a key driver. You have to have healthy money management skills and know your ratios in order to manage the ongoing process over the years. So liabilities reveal a lot about your relationship with money because they become very problematic if they exceed your assets. That creates what's called a negative net worth. You owe more than you own. If you're a business, that's called insolvency. So you really want to shoot to not be in that place. Liabilities can cause problems by interfering with your ability to pursue other financial goals. So if you have so much debt payment you can't save for retirement or build up an emergency fund, you're in a bad situation, and the first step in your plan is to figure out how to get out of that. So the type of debt you incur is a really important factor. Some liabilities actually help increase your net worth over time, like home mortgages, business loans, and yes, actually student loans too, when done appropriately. Other liabilities don't add to your net worth. So if you use your credit card to buy clothes and dine out, you're going to be in a bad situation. Those items, dining out, things like that, can be gone before the bill even comes. So let's look at liability management wellness ratios. And these will look familiar to those of you who have businesses. So asset to debt ratio compares your assets you've accumulated against your liabilities. You want this to be a number that's rising over time, meaning years, not short term. Then you have liquidity ratio. That's your cash over how much you have in monthly committed expenses. It shows your ability to meet your committed expenses in an emergency. 3 to 6 is the number that you want to see that number at. Your debt ratio service is going to tell you the percentage of income that you're using for your debt repayment. The lower the ratio, the better you are with your debt management. So short-term liabilities over total income. Your saving ratio is going to look at your monthly surplus over your monthly income, and that's the percentage of your income that is being saved for the future. The higher the ratio, the better off your financial wellness. And I'm glad to see some folks joined us that said they're very comfortable handling their personal finances. Yay, maybe we get some good feedback when we start the Q&A part. So cash flow management. You spend less than you make. And I know I talked about this is not another personal finance lesson like you've gotten before. You cannot talk about personal finance without talking about cash flow management. So do you spend less than you make, and do you know what your bank balance will be in 6 months? And this slide and the next one actually particularly talk to the content of the 15th webinar on balance sheets and income statements. So every business keeps a cash flow statement. I'm saying that personally, you should also be doing the same, because your net worth statement is just a snapshot in time. It's basically your personal balance sheet on a given day, where the cash flow statement is actually a money management tool. So it's like a budget or an escrow analysis that you get if you have a mortgage and you see every year they say, we expect to pay your taxes and your insurance on these days, and we expect your escrow payment to come in on these days, so here's how much your payment has to be to keep that all flowing. You can do the same thing personally with your own budget. The key to actually making your budget work is showing the timing of the income and expenses. So the when, where, and why of your cash flow. When are the inflows received? Where are they coming from? When are the outflows due, and where do they go to? There's a very simple way to do this. If you're not a numbers person, you're not into spreadsheets, and you're not into balance sheets and statements like that, get out a blank calendar and put on the dates. I paid on the 1st and the 15th. This is how much is coming in. here's the day, you know, on the 5th this is due, and on the 1st my mortgage. Put that on the calendar, and you can actually see the flow of the money coming in and out each month. So you know if you have $500 coming in on the 1st and only $300 worth of bills, you have $200 extra, but maybe you can't spend that because if on the 15th you have $500 coming in and $600 worth of bills, then you really can't spend the $200 from the 1st that you had extra because you're going to need that after the 15th when the rest of your bills are due. You only have $100 extra to spend, for example. So number 5 key is having a financial plan. So I said a plan is part of this. Here's where it fits in. You want to look at what does my life look like after work or whatever regular income flow I have coming in that's going to stop at some point in the future. One of the keys, again, in tying all of this back to your timing, your investment management, your risk management, is when do I want to retire? That helps you get your time horizon established for your planning, and then everything kind of falls in line behind that. But having a time frame in mind helps you to have something to kind of backstop what you're working toward. And then you want to think about where do I want to live? Cost of living can vary wildly. And what kind of lifestyle do I want to live? Do I have a bucket list I'm going to be going crazy on? I had one client, she was 78 years old, and her bucket list item was she wanted to take her whole family on an African safari that was going to cost her $200,000. She built her plan to be able to do that, and she did it. She did an African safari at 78 years old, which is just the coolest thing ever. But what do you enjoy doing now? Are there things I want to keep doing, or are there things I want to try, and what does the budgeting look like for that? And I have an exercise I do with the people coming through either my challenges or my mastermind classes that say, what do you want said at your eulogy? And we go through this process of, you know, what do you want your life to mean and when you're not here anymore? And then realigning how you're spending your time to line up with what you want that to look like. So it all comes back to money sometimes. How do I fund that vision? One of the keys is to estimate your expenses by breaking them up. What's essential? I have to have food, shelter, clothing. Discretionary is these things would be nice to have. I want to take 3 trips a year to XYZ, or I want to be able to join the club and go golfing every day. Whatever that is that's discretionary, nice to have, but isn't vital for you being able to survive in a comfortable fashion goes in that bucket. And then you look at the income sources you have coming in. What are guaranteed income sources? Pensions, Social Security. Those things you know are coming in, you match those to the essential expenses that you know, like your mortgage and your electric bill and your insurance, etc. Then your variable, your dividend, your interest, your capital gains, things like that that are coming in. And you set that up to help fund some of your discretionary expenses. And then if you want to go above and beyond, you can pick up a few hours, do some consulting, or have another bucket of savings. I have a lot of clients that have a bucket of like crazy money, they call it, for things they want to do without affecting their lifestyle or their long-term plan. Number 6 is distribution at death. And I always ask the question, have you left behind a legacy or labor for your family? If you fail to plan, then you're leaving labor behind for your family. It's a mess, and it's a lot of work to clean up. Unfortunately, a lot of people think that to have an estate plan, you need to have a lot of money. That is not true. Estate planning is for everyone, not just people with large estates. Communicating your wishes is another, that's driver number 6 in creating your wealth alpha. You have to have that communication because proper planning doesn't just minimize taxes, it also minimizes expenses associated with distributing those assets. It makes sure that those assets get where you want them to go, even if you don't have a lot. In fact, what I've found in 30 years of doing this is that the less you have, the more important it is that it goes to where you want it to go in a lot of cases, because they're things that are personally of meaning to a particular client, not meaning valuable dollar-wise, but valuable personally. These plans also outline your preferred medical treatment in cases of incapacity. It designates who's going to manage your assets if you can't. All of those things have to be laid out ahead of time, or it's a court process in order to be able to have somebody help you. Proper estate planning reduces or eliminates probate costs associated with distributing your assets. So probate is not private. Anybody can go in and see what wills have been probated and where those assets went, how much and where. So it's not the ideal way to pass your assets. And if you have children or incapacitated family members that you care for, it's even more important for you to have documents, because you are responsible. You're the person. You have to name a guardian that's going to take care of that loved one after you. If you don't and there's no document, the court's going to decide who's going to care for your children or who's going to care for your loved ones that are incapacitated. And that may not be the person that you would have chosen. And even once you've done these documents, you need to go back over them every few years to make sure nothing has changed. Now, why are these documents important? Because there's 4 ways to pass assets to heirs. By contract is the first one. And those are things like life insurance policies, IRAs, qualified retirement plans, annuities, payable on death or transfer on death designations on your bank accounts. So those are cases where there's a named beneficiary on the account of the person who died. And then there's by law. Those are cases where the titling on the account names the owner who automatically receives the asset of the other owner's death. So I talked a little bit about that, joint tenants with right of survivorship or joint tenants by entirety mostly. And then they have by trust. So people set up revocable trust or irrevocable trust. They put assets into that trust and then say, this trust tells us what we want to happen to the assets that are in here when we pass away. And the trust is contractually bound to make that happen. And then they have by probate, which is the last way. That's the process that's used to distribute assets for people that either have a will or don't have a will. And that's all they have. It's a public process. There are fees associated with it, even for a small estate. So ideally, you try to avoid probate when you're setting up your plans. Documents that everybody needs for their plan are a will, a power of attorney, which is the financial or general that can handle assets if you're incapacitated, as well as a medical power of attorney. Who can speak for you if you're incapacitated and in the hospital and need medical care? Who do you authorize to make those decisions for you? The living will, I call this the unplug me or leave me plugged in document. This is where you stipulate if you were in an end stage, brain dead, things like that, what would you want done for food, nutrition, relief, and whether or not to artificially have your life prolonged. You make those decisions then instead of leaving it up to your family. It's one of the kindest documents you can ever do for your family members, to take that weight of that decision off of them and have them just implement what you want. And then a revocable trust is where you keep everything so that it's not public in the probate process. The trust says where you want everything to go and can allow other types of planning for special needs people, tax planning, income planning, things like that to take place within that document. Number 7 is tax planning. So be intentional with your tax planning, because understanding how you are taxed, what breaks, credits, and deductions you qualify for is a key driver in creating wealth alpha. So the tax law says you need to pay taxes, but it doesn't say you have to pay more than you need to. It says you can use these regulations and rules to pay the least amount that you are legally allowed to. And I'll give you a perfect example. I had somebody who was asking me to look over things, and he wasn't going to declare about $6,000 worth of income that he had made under the table, I put it that way. He didn't get 1099 for it, is what it amounts to. And when he did his tax return that way, he owed $42 at the end. Not a big deal. But when he redid his tax return as a self-employed person, declared that income, and properly took the mileage deductions and a couple other things against it, he actually got money back in his tax return after declaring more income than he had originally declared. So it's really important to understand those types of things and look at how you can make sure that you're getting what you should be getting and using what you should be using. The more you can keep of your own money, the easier it is to get to the next step of reaching your goal. And number 8, I said key to Wealth Alpha is setting goals. What do I do with all this information? Why do I need all this information? Well, in order to stick to a plan and even to get one developed that means something to you, you have to understand what matters to you most. Why do you do all this work? Why do you work so hard? What is the end game? What lifestyle do you want to live? Think about it. Are you living the lifestyle now? Do you want to just maintain this, or is there something that you aspire to that you want to be able to fund? And then what's your definition of success? What is enough for you? And I can give you an extreme example. I had a client who was worth $75 million and thought he was going to run out of money. It wasn't enough for him, but he wanted to be able to fly to Philadelphia on a private jet, a couple times a month for cheesesteaks. And then he was worried about running out of money. And then I've had clients who had, a fixed pension and $20,000 in the bank, and it was more than enough. They didn't even spend everything that they had. So it really depends on what your ideal tomorrow looks like, what enough is for you. And really uncovering that will do so much toward helping keep you motivated to get your plan done and follow through with these things. So I always say, who do you have on your bus? I joke that for my clients, I'm driving the bus for them, but I don't do everything. There are attorneys and accountants and sometimes other financial advisors, other business coaches, things like that on the bus. But it's to look at who's on your bus and what's the most efficient path to get to my goals. And do I need to add anybody? Do I need any other types of advisors? And I will tell you, when you're doing planning, these things all need to be being looked at by whoever's helping you. They need to be looking at how all these things interplay, not just what's your investments and where should we put them. Discuss changes with your advisors. So when you hear things about tax laws coming up are changing, or things like, what's going on now and all the stimulus packages, you really need to sit down with somebody and talk to them and figure out what are the things I can take advantage of and what things can I use. How do I need to adjust my estate or my financial plan as my life changes? So regular touch bases, even if it's just to ask questions. Take the time to set yourself up for the optimal chance of achieving what your personal definition of success is. So how do I get started? First of all, look at who's on your bus. Who is on your financial wellness team right now? Do you have an advisor? Do you have an attorney? Do you have an accountant? Do you have a money manager? Any of those people? And do you need to add any of them to my team? And then look at what resources you have that you can apply to your goals. So what one way in the next 30 days can you apply a resource that's unique to you to help reach your wellness goal? It could be a relationship you have with somebody that you can reach out to help you understand a little bit further about how to do a cash flow statement that'll work for you. Something that simple would be a step because you know somebody that can help you with that. That's a resource to you. And then discuss 3 things from this session with the advisors that you have, or with a new advisor if you're going to go out and look for one, so that you can look for ways to plan ahead and really get started putting this all together. There are different ways if you want help getting started. I offer workshops and retreats, which right now are virtual, and then online learning and one-on-one coaching to go through the entire process if you're interested. And I can also help you figure out, how to utilize maybe advisors you already have. So, for example, my online masterminds cover 12 different topics, the 8 key drivers plus 4 things that are timely and current. So, for example, one of the first ones we're going to be covering is the stimulus package. And then we cover one topic every month and are able to help get your blueprint built. We have a one-day local workshop, which is also going to be virtual as well to help jumpstart you. And I'm doing actually a free 12-day jumpstart to get everybody started. It will start next Wednesday, and each day will cover one thing and have one small step that you can make toward getting your blueprint built. If you're interested in more information, please feel free to reach out to me at enhanceyouralpha.com. And
great. And I think actually we have some questions already from the audience. So if you are interested in putting in a question for Renee, you can do that in the Ask a Question tab. So we already have a question that someone put in, which I think is something actually a lot of people are thinking right now. It says, with everything going on right now, I feel like I have no control over a long-term plan with my finances, job, etc. How can I plan for such unknown circumstances without a definite income and expenses? Oh,
that is a wonderful question, actually. And that actually applies even to a regular plan when circumstances aren't like this. Nobody knows what the future holds. So the first thing I'll tell you is to remember that a plan is not a static document. It's a living, breathing document. So what you start with is, what is your circumstance right now and what are we building toward? And then we adjust as things change. So you don't have definite income. Well, you do have definite expenses. Everybody does. You know, you have to have a roof over your head, and you need food, and you need certain things. So you start from back to the slide when I talked about the must-haves. There's some must-haves that are definite expenses, and you start building to those, and then you kind of expand out from that. So, okay, what discretionary expenses? Now, what do we have coming in right now? What can we cover now? What can't we cover? And, you know, to be honest with you, with some of my clients right now, a lot of them are business owners, and so it's robbing Peter to pay Paul, quite truthfully. But it's having a structure and a plan around it so that you know how you're going to get back out of it the other end.
Great.
So there isn't a definitive answer, and it's never a definitive, here's what it's going to be. It's a living, breathing document that just helps you to have more control over what you can control.
All right. We have another question here. Someone's asking about cash flow statements. How do I get started making a cash flow statement without fancy software?
Okay. So calendar. Find a calendar, or you can print a free one, blank one, off the internet, and start with putting your income in where it comes in on those days and the expenses on the days that they're due. And you can figure out, you know, in the first week of the month, I have this much income and these many expenses, et cetera, et cetera. You can actually see it on the calendar. If you don't want to use software, you don't like using software, that's a very quick and easy way to visualize each month where your flow in and out is coming from and going to.
All right. We have another question. Do I need to wait until I have cash to invest before seeking out a financial advisor?
Absolutely not. You just need to be careful the type of advisor you get, honestly. There's a lot of advisors out there, or coaches even, that will work on a fee basis, hourly, or as part of a program or a package. Money managers are the ones that are going to require you to have some money. But I would say that getting a plan together, even when you don't have a lot of cash to invest, is probably even more important, because that's what's going to get you to that point.
Okay. And another question. If I heard you correctly, you said everyone should have estate planning documents of some kind, even if they aren't rich. Why would, for example, a 20-year-old with no assets need planning documents?
Perfect question. And I can give you an exact answer. So had this happen to a friend of mine. Her 19-year-old, 20-year-old son is away at college and had a medical emergency. They wouldn't give any information to her, wouldn't speak to her, and wouldn't take her direction as to what to do, because he's an adult and he didn't have a healthcare proxy.
Oof.
Yeah.
That's like my terror. That's like my terror.
If you have kids, every one of you on here, if you have kids who are over the age of 18, you need at minimum a healthcare proxy, and preferably a power of attorney as well over the financial affairs, to make sure that you can actually handle what you need to handle for those kids if something happens.
And that's over the age of 18, not 21?
Yes.
Okay. Good for me to know. I have 2 kids.
Very important. It is, you know, and I didn't even think of it, and I've been doing this for 30 years. And I was talking to an attorney I work with regularly, and he's like, hey, isn't your son, you know, whatever? And I said, yeah. And he goes, when's he coming in to get his docs? And I looked at him like, oh my gosh. You know, I didn't think of it. So even those of us that do it every day, sometimes something that obvious, you know, doesn't present itself until you know somebody that was in that situation.
Great. We have another question. It is, what's the difference between a financial planner and a financial advisor?
Well, technically it could be nothing and it could be everything. It depends on the company they're for and what the labels are. So a lot of times financial planners will be for a fee. So they'll charge you a fee to develop the plan. And a lot of times financial advisors maybe might not charge a fee. They might charge you assets under management, but then they're not going to do a plan for you unless you're moving money to them. That's not always the case, though. So some of it's just industry however they're using the terminology, at least from what I've seen. There's no discernible difference. I think originally there was supposed to be.
All right. And any last, and any last tips or advice before we say goodbye today?
Absolutely. So in these trying times, I would say that the best thing that you can all do for yourselves right now, especially if you're uncertain on how things are going forward, is to either take the time to learn what's available to you in your particular situation through the stimulus packages, through your state, sometimes through your local counties even, or from local business organizations. I've seen a lot of that going on in different markets. And learning about all that and figuring out how you could take advantage of it is going to be key. I just gave advice to somebody who was getting ready to lay off. He just started a fairly new business and had 5 employees that he was going to lay off. And then when we actually went over the stimulus, the Payroll Protection Act and everything, he said, I think I can do this, without having to lay off his staff, when he originally thought he was going to have to because he was getting misinformation.
All right. That's great to know. I think we're all going to be looking at that information.
Please feel free. If any of you have more questions, there's a link at the bottom for a free 30-minute consultation with me. You can go ahead and schedule it. There's no back and forth with email or anything. And I'm happy to talk to you guys one-on-one to try and help, because everybody's going crazy right now. And anything I can do to give people guidance, I'm more than happy to do so.
Fabulous. And we also have one additional poll asking, how confident are you that you can apply some of what you learned today to help improve your financial wellness? And in addition, we would also always love to get feedback from our audience. And so if you can give us any comments, feedback, give us a vote on the number of stars for this presentation. That helps us in the future as we are scheduling our webinars and our events. So Renee, thank you so much for joining us today, and keep talking out there, folks.
We had one more question.
Oh, yeah.
They wanted to know if they could get copies of the slides.
Ah, gotcha. And they will be getting copies of the presentation. So they will be getting a copy of the recorded stuff. And if they open it up full screen, they should be able to see anything they missed. But
perfect.
And you
if
had
any
something?
Of you have any questions, if anybody has any questions after doing that and you still can't read something or whatever, hop out on the 30-minute free call, and I'll be happy to go over anything with you.
Great. Thank you so much. All right, folks. Have a good day.
You too. Bye.